Hello and welcome to yet another episode of London Eye. My guest today on the show is the Chief Investment Officer of Allianz Global Investors, Lucy Macdonald, who manages $140 billion of equity money across the world, including India. Lucy, thank you very much for joining us on the series today. But let me start by asking you how comfortable you're feeling about equities generally after what has been a fairly volatile start to the year.
We are expecting flatter returns from markets and more volatility. And that's after a period of very strong returns and very low volatility for the last 5 years. And now we think we're in a period where we're going to get just more difficulty in really getting those returns, because we think we're at a peak liquidity as far as the quantitative easing is concerned. We think that corporate profits are now very strong and unlikely to be growing as quickly next year, particularly because we're not going to get the repeat of the US tax benefit. And then from where we're starting, the valuations are quite high, so it's difficult to see a real revaluation upwards for all equities. All of that together suggests to us that returns are going to be flatter, and we think there will be more volatility, a lot of that due to geopolitics.
You alluded to almost 3 peaks out there.
Yeah.
Does it mean that the markets and generally the economic conditions are beginning to level off or even slide off a little bit from here?
Well, as far as the corporate profits, which is the most important thing for the equity market, yes, we do think that we will get a deceleration into next year because of that factor in particular of not repeating the US tax reform. However, we're also at quite a high level of margins, particularly in the US as well. So it's difficult to see that you can get much more margin upside, and at a time where you're beginning to see some deceleration in the top line. So overall, that does suggest to us we are seeing a peak in corporate growth at the moment.
But you're not ready to call it the end of the cycle as such in developed markets yet?
Well, it's closer to the end than the beginning. But what is, we think, still going to be a support, and why we think it's not going to be any worse than flat, is that the monetary environment, we think, will still be supportive, and that the reduction in liquidity that we're going to see is going to be affected very carefully by the central banks, and that they will take their time in raising interest rates and in removing the liquidity from the system, because they are still very, very aware of the risks to the system, and they don't want a repeat of the global financial crisis. Now, there is still a lot of debt in the system. That's actually more debt in the system than there was pre-financial crisis. And so it is still a very fragile environment, and all of the central banks really understand that.
So the volatility which has crept in this year, do you think it's a function of the issues that you spoke about, or is it to do with some fear of external risks which seem to be rising around the market?
Well, I think that there are 3 real reasons for the volatility that we've seen. One is geopolitical, and particularly trade tension, and that's really come to the fore this year, and I think had probably been slightly forgotten towards the end of last year. So that's one thing, and that is a real concern. Second, I think there are a slight inflation upward surprise that really came into the market in February, and that was really as a result of the higher than expected wages in the US, and that was a real concern and a little bit of upward surprise. Everyone's been looking for some wage pressure. No one had ever seen it, for years, and suddenly there appeared to be a bit coming through. Now, whether that is sustained in the rest of the year, we don't know yet. But that was another reason. And the third was just this feeling of higher rates and removal of liquidity. And so those are all reasons, why we think there will continue to be a bit more volatility in the market now than there has been over the last few years. However, for active investors like us, we don't think that's a bad thing. Actually, it's more healthy having more normal levels of volatility in the market, as it is having more normal levels of interest rates. And we've been living in an environment which has been very abnormal, and volatility, you could argue, has been too low, and that risk has not been priced properly. So going into a more normal environment, we think is probably healthier for all concerned, but it is more challenging, and it certainly is more challenging to really deliver the sort of returns that have been delivered in the last few years.
You mentioned active investing, and there's a big debate going on whether active investment actually can deliver alpha over passive investing. Where does the debate stand in the West right now with regard to that?
Well, it depends. And it depends on the asset class that you're looking at. It depends on the environment that you're looking at. And from my perspective as a global investor, it's very clear that it is possible for the average investor to add value in global equities. The median investor outperforms the index over time. So it is an area where there is a possibility of adding alpha. Now, that you can't say the same in all parts of the market, and particularly in US large cap, it's difficult to make that case. However, in the last year, it did do better as a whole. But global is certainly possible, and that's because there's still anomalies around the world, and not all investors are equal in this. So it's indeed possible to do that. However, you can also say it's more challenging than it used to be because there is more competition, and that the alpha generated as a whole is lower than it has been historically. Now, part of that we think is also to do with the fact that volatility has been lower, and so that seems to be correlated with this sort of lower alpha generation. However, it is still possible. And certainly, we think we're going into an environment where active investors should be able to do a bit better for two reasons. One is the fact that you are getting now a more differentiation on balance sheets. And so as the liquidity is withdrawn from the market as a whole, those companies which have stronger balance sheets and able to finance themselves should perform better. And therefore, you should have a bigger differentiation. If there's a bigger differentiation, then active managers tend to do better. And the second reason is that we think that there is a huge surge of change going through, which is due to technology. And that's affecting companies very differently. It's affecting, some companies are very much ahead of the curve, and they are investing in the technology and gaining share within their own industries. Others are lagging. And that is also giving a bigger differentiation between performance of companies. And that, again, if you have good research, you're able to differentiate between those winners and losers within each industry. So overall, those factors, we think, are leading to a better environment for active investing, plus at a time when the beta itself is going to be a bit flatter.
You said that we're probably closer to the end of the cycle in the US, but where are we in the cycle with regard to the emerging markets? Because the EM cycle did not quite start when the US cycle started. It may be just 2 years old or 2.5 years old. Do you see EMs actually fleshing out their cycle for a few more years, regardless of whether the US cycle actually ends over the next 1 or 2?
There is more scope. But it's also, there's more structural potential, which in the end of the day is more interest to long-term investors. So, we can call, the cycles, but really what we're interested in to see is where is there good long-term structural growth? And there certainly is in the emerging markets. As long as an equity investor, you can find the companies which are able to benefit from that. And that can be companies in those regions, or it can be companies based elsewhere who are benefiting from that growth. And that, in the end of the day, is more interesting than short-term cyclical changes.
How do you look at a market like India in that context? I mean, you run a global portfolio. India is just another market for you. But since you are very stock-specific in your approach, have you in the past been able to spot high-quality companies with great growth potential which have been realized in a market like India?
Yes, and particularly in the technology sector, where there is a very strong domestic and international growth potential, and companies which can compete on a global stage. And that, for us as global investors, is what we're interested in, is seeing where the companies are which have really been supported and have been able to compete. And that is an area where we're still interested. I think what's changing there is for the Indian companies is that the end clients for all of them are demanding higher value-added service, and they are changing the scale of the projects that they are asking for. And that so means that all companies need to be able to provide a lot broader services than they did in the past. So it's not just a question of outsourcing or even consultancy. It's a question of delivering very wide service offerings and digital transformation projects which are taking enterprises and moving them completely into a digital space. And that means having capabilities in cloud, in security, in automation, in all of these areas which the service companies wouldn't traditionally have, but they're going to need to do if they're going to be competing on the world stage.
The other theme which people in India back home are very excited about is the domestic consumption theme. But do you find good companies there as prospects in your investment basket, Indian consumers?
Yes, I mean, our specialists in the area like the jewellery space, and that looks to us to be one which has got quite good demand growth. Even some of the areas which are sort of slightly lower growth are seeing slightly better prospects now in the rural areas, like some of the food companies, which have been a little bit depressed, but that seems to be picking up now. But there's huge potential, structural potential for consumption in India, and it's finding the companies which are both there and externally which are really able to benefit from that.
I come back to those external risks that we spoke about. Some global investors have begun to fret over issues like Argentina, Turkey popping up here and there. Do these have the potential to insert far more risk or volatility into the market, you think, in the foreseeable future?
Yes. I think the biggest geopolitical issue that, as I mentioned, is trade, because that's the one that can have the biggest impact on overall global GDP. There are many incidents which happen around the world which are very dramatic, or can be very tragic, but they don't necessarily have a big impact on the overall economy. And at the end of the day, when we're investing, that's what we're interested in. So it's trade and any real disruption in trade, which is the big concern at the moment, and seeing how that escalates or not between China and the US, and how other companies get hit in the meantime by that is something that we're focusing on a lot. And one area in particular focus is the technology area, because there are big, long supply chains which go across the world, which can be affected by this. So that's one area we're looking at. Within that context, however, and if that is one of the biggest risks to growth, India looks relatively well placed because it's got such a good domestic focus. And that, I think, from the global investors' point of view and emerging markets investors' point of view, means that they will go to India when they're concerned about some of those big worries globally. So in fact, India can be a relative beneficiary of some of that.
Time for a break. We're back with Lucy Macdonald of Allianz Global Investors on London Eye. That's in 2 minutes.